Do you know what the difference between gross profit and contribution margin is? Do you know how to calculate the break-even point on one of your products? This video is for you. In this video, we will start by looking at the definition of gross profit. We will then look at the definition of contribution margin. Once we understand these two concepts, we will then look at how to use contribution margin to calculate the break-even point of a product or service. And finally, we will contrast the forecast number of units against the break-even number of units. With that, let's dive into the presentation. We start with a typical income statement. Cost of sales is deducted from our revenue to calculate gross profit. However, we need to look more closely at what cost of sales comprises. Upon closer inspection, we see that cost of sales represents all costs related to purchasing or production of our goods and services. It is important to note that these costs could be fixed costs or variable costs. We also note how we can divide the gross profit by our revenue to calculate the gross profit percentage. We then subtract all non-production or non-purchasing costs. Again, these could be fixed costs or variable costs. And with that, we have calculated our operating income. We also note how we can divide the operating income by our revenue to calculate the operating income percentage. Next, we rearrange our previous income statement. Instead of grouping costs as production and non-production, or purchasing and non-purchasing, we group costs by fixed costs or variable costs. We now deduct all variable costs from revenue. These can be production and purchasing costs, or these can be non-production and non-purchasing costs, as long as they are variable in nature. The result is called the contribution margin. It is worth noting that contribution margin is different to the gross profit previously calculated. This is because our focus is on subtracting variable costs when calculating contribution. Our focus was on production and purchasing costs when calculating gross profit previously. We also note how we can divide the contribution margin by our revenue to calculate the contribution percentage. We then subtract all fixed costs. These could be production and purchasing costs, or non-production and non-purchasing costs, as long as they are fixed. The result is our operating income. It is worth noting that the operating income is consistent to what we had calculated previously. Again, we note how we can divide the operating income by our revenue to calculate the operating income percentage. Next, we contrast the two calculations. We can see that gross profit percentages are different to contribution percentages. However, operating income percentages remain consistent for both models. This makes sense, as it is only the order of expenses that we have rearranged, and the final operating incomes didn't change. we can focus on the total columns and get a sense of our overall P&L and related percentages for gross profit, contribution, and operating income. We can also focus on the individual products and services and note the differences in percentages for gross profit, contribution, and operating income. This illustrates the importance of analyzing our P&L by product or service. Next, we consider the key formulas for break-even analysis. As we have already seen, when we calculated our contribution margin, we identified a self-explanatory formula. Net profit is equal to revenue minus variable costs minus fixed costs, which can be simplified as net profit equals contribution minus fixed costs. We can then restate these equations such that net profit is equal to the product of the number of units and the unit selling price minus the product of the number of units and the unit variable costs minus fixed costs, which can be simplified as net profit equals number of units times the unit selling price minus the unit variable cost minus fixed costs, which can also be simplified as net profit equals the number of units times the unit contribution minus fixed costs. Next, we set our net profit as 0, which is actually the break-even point. 0 equals number of units times unit contribution minus fixed costs. Rearranged, we have fixed costs equals number of units times unit contribution. Rearranged, we have fixed costs divided by unit contribution equals number of units. This is the break-even formula. With that, we can lay out the key considerations when it comes to break-even analysis. What is contribution? Contribution is the difference between selling price per unit and variable costs per unit. When is break-even? Break-even is how much contribution you need to match your fixed costs. How many units do I need to sell to break even? Fixed costs divided by contribution per unit. What is my forecasted profit and loss? Contrast forecast number of units sales versus break-even number of unit sales. By referring to our previous calculation, let's make an assumption on the number of units that applied. Product or service A, 226. Product or service B, 201. Product or service C, 176. Product or service D, 151. Product or service E, 126. And with that, we can calculate all the required inputs for our formula and the corresponding break-even points. Product or service A, 64. Product or service B, 85. Product or service C, 104. Product or service D, 133. Product or service E, 99. We can also visually contrast our forecasted number of units against the break-even unit. We can see product or service D and E are only just breaking even in our forecast. We also recall that product or service E had a very high contribution margin of 70%. On this basis, we may decide to allocate more resources and time to selling product or service E in order to achieve a more efficient overall P&L. In this video, we learned about the differences between gross profit and contribution margin. We then contrasted the two approaches to viewing our P&L and considered some of the differences and similarities. That was followed by first inspecting the total P&L and then looking at the detailed P&L by product or service in order to appreciate the value in detailed analysis. Next, we learned about break-even analysis and the considerations required in understanding how to calculate the number of break-even units for a product or service. And finally, we worked through a detailed example to calculate the number of break-even units and contrast them visually against the forecasted number of units. By doing this, we could easily see which products or services were far exceeding the break-even point and which ones weren't. And as a result, we were able to conclude where to dedicate our resources. If you enjoyed this content, please like the video, subscribe to our channel, and click on the notification bell. It helps us grow the channel and bring more content to small and medium business owners and managers. Also, be sure to check the description below for any related product affiliate links. And finally, please comment on the video or click on our community tab to further interactions and updates.